Welcome to this LMN video on using your field labor ratio. Just to refresh your memory, the field labor ratio is this. It's your field labor wages divided by your sales. So more or less, you take the wages that you pay your field staff, the people whose time you estimate, and divide that by your total sales to get what percent of your sales is then spent on the wages for the staff who do the work. Remembering that our definition of field labor ratio doesn't include the burden. So it doesn't include payroll taxes, etc. It's simply the gross wages divided by the income or the sales that those wages generate. Your field labor ratio can be used for a lot of neat things, but here I'll show you where to find it on your budget. When you're working on your field labor budget, your field labor ratio is shown here in this tile. My example shows 26.5%. This labor ratio means that for every dollar we earn in sales, we spend 26.5 cents on the wages to get that work done. Now, what's shown beside this is the industry average, 26.2 cents. So I actually spend, in this example, a little more than the industry average on labor. Now, that doesn't mean I'm necessarily right or wrong. Normally, it's a good thing to be less than the industry average. The less your labor ratio is, the more productive your company is. The higher your ratio is, the less productive your company is. But certain companies are going to have different things that make them more or less productive by no fault of their own. You might be undercharging your work, not charging enough for your labor. That'll bring your ratio up higher. You might be overpaying your staff. You might have too many staff. You might work too many hours. Or, like we talked about in the labor video, you could have more or less equipment than the average. You could use more or less subcontractors. There's a lot of different variables here that might mean that your ratio just doesn't fall into the industry averages. So while it's not intended to tell you that you're wrong, it's just intended to give you a guideline of where most companies are at based on the mix of work, because the ratios change a lot based on work. Install companies tend to have a lower field labor ratio because they have so much more materials that make up their sales. Maintenance companies or service companies have a higher field labor ratio because they install very little materials and therefore have very little sales generated by materials. Now, the purpose of this video was to show you why that field labor ratio can be useful for you. So let's take a look at 3 of the main reasons. Number 1, benchmarking. You can compare your labor ratio to other companies in your industry or even your peers to see how you stack up against the industry. Or you can compare your labor ratio to previous years in your company. So if you know year over year that 3 years ago I spent 26% on wages, 2 years ago was 28%, and last year was 25%, there's a good chance that my forecast for this year should be somewhere between 25 and 28%. History tells us that's about what we spend on wages as a percentage. Certainly makes budgeting a lot easier when you know your historical percentages. But it also helps you stack up against the industry. To see where you stand versus your peers shows you how productive or not productive your staff is compared to your peers as well. Another great use for your field labor ratio is helping to put together accurate forecasts. So once you know where your ratio should be and where it's been at for previous years, so you're pretty sure it's realistic, it can really help you tune your budget to changing conditions. For example, let's say you need to hire 2 people this year, or you feel like you need to hire 2 people this year. What extra sales should those 2 people generate in order to stay profitable? Well, that can be pretty simple. If your field labor ratio is 25%, then you simply need to take their wages and divide them by 0.25 to figure out how much sales you need to generate in order to stay at your field labor ratio. So for example, if your field labor ratio was 25% and I wanted to add 1 laborer at a $25,000 wage, I'm going to need to have that labor generate about $100,000 in sales to make my numbers work, to stay at the right field labor ratio. This comes in real handy when you're thinking about adding a crew. So simply add up what you would expect to pay the crew in a year, divide that by whatever your field labor ratio is for that crew, and it may be different depending on whether it's a construction or a maintenance crew, and then you'll get the sales goal or production goal for that crew. That's going to tell you how much work you need to sell to balance that crew's wages. Let's take a quick example again. Let's say you're thinking about adding a 2-man maintenance crew, and their total wages are $50,000. If your maintenance field labor ratio is 30%, then what you need to do is take 50,000 and divide it by 30% or 0.3. It makes budgeting for additions or subtractions of people very easy. It also will help you budget for the amount of labor you're going to need to increase your sales. So for example, let's say you're profitable, but you want to grow the company by 200,000. If your field labor ratio is 25%, then you know you're going to have to add about $50,000 in wages. 50,000 is 25% of your 200,000 in order to grow by that much. Now, if you're not profitable, you might need to add $200,000 in sales just to stay profitable or stay competitive. So it's not necessarily that you have to add employees. But if you know you want to grow and you know you're going to have to add employees, it's a good benchmark to help you do that accurately. Finally, your field labor ratio can be used for helping you put in an incentive system to get employees to think beyond the hourly wage and really come up with a win-win for the company and for the employees. If you know what a fair field labor ratio is, and once you've got some company history, and once you know you're profitable, you can do this quite easily, then you can put in an incentive or a bonus system to those who go above and beyond their production goal. Let's take a look at that in detail. Let's say we've got a foreman named Jeff, and Jeff's wage is about $40,000 in a year. Now, Jeff works with 2 laborers, and they each make about $25,000 a year in wage. It doesn't really matter at this point who they are. We just know that Jeff runs a 3-person crew with himself and 2 laborers, and by the end of the year, we expect to spend about $90,000 in wages for Jeff's crew. So the question is, how much work should Jeff generate in order to justify or be worth the wage that we're paying him? This can be made really easy with a field labor ratio. So let's start with that total crew wage for Jeff. And why do we use the total crew wage? Because Jeff is the foreman and he's responsible for the production of that crew. Now let's divide Jeff's crew wage by your company's field labor ratio. For this example, I'm going to use 25%, but it's important to remember you need to use your own ratios in order to set your own goals profitably. And these ratios may differ by division. A construction ratio is going to be very different than a service or maintenance ratio. So assuming my ratios are accurate, I've got Jeff's wage at $90,000. I divide that by our company or that division, if it's a division budget's field labor ratio of 25% to arrive at a production goal for Jeff's crew. And that production or sales goal is $360,000. Jeff's crew needs to produce $360,000 worth of work in order to make his wages 25% of sales. Once we know that, we can bring Jeff in a meeting and simply explain this to him. Jeff, here's how much we can afford to spend on labor. Here's your production goal. When Jeff comes in and is looking for a raise next year to $50,000, it's pretty easy to see whether Jeff's worth it or not. Take Jeff's raise, add 2 labor, and the total now bumps that crew wage up to $100,000. Following the steps we did before, if the crew's wage is $100,000 and our field labor ratio is 25%, then Jeff's crew, their goal now is $400,000. So in order for Jeff to be worth a raise of $10,000 a year, his crew needs to crank out about $400,000 worth of work, or about $40,000 more than Jeff was doing when he made $40,000. So it becomes a really easy system to communicate and understand and objectively measure foreman's productivity, to give them a way to get to a higher wage level and to get your company to a higher production and profitability level by growing sales and in turn growing their own wages. But remember, while they grow sales, while they get more productive, while they make less mistakes, you're doing this with the same equipment and the same overhead and getting more profitable as they evolve. So it's really a win-win scenario for the crews, for the company, and ultimately for everybody involved. It makes performance evaluation and raise discussions a lot easier when you could look at numbers in black and white instead of arguing about who's working hard and who shows up on time. And to be frank, most people get a raise because they come in the office on the right day of the week. And this makes it a lot easier to put in a system to determine who's worth raises and who's not. All you need to do to calculate how much production each crew does is, as you build invoices throughout the year, or perhaps you only want to update this once a quarter, is just make a spreadsheet of all the invoices you created in that quarter and then assign them to the crew who did the work. That will show you how much production each crew did within that quarter and ultimately at the end of the year. If 2 or 3 crews ganged up on a job, well, then you can split that job's invoices 2 or 3 ways, however you see fit. There's always going to be a bit of subjectivity there. It's impossible to calculate exactly how much revenue each crew produced on any given day. So you may have to get a little creative when looking at a job that was run by 2 or 3 crews. You may have to split it 20, 30, 50, or whatever you think was proportionate to the amount of work each foreman put in. But ultimately, by keeping this spreadsheet, at the end of the year, you'll have a total revenue produced by each foreman so that you can, going into next year, evaluate who's worth what they're being paid, who's not, who should be paid more, and clearly demonstrating that your company has a system that will reward performers and ultimately penalize those who make a lot of mistakes and aren't very productive. If you have any more questions about your field labor budget, be sure to email us at support@golmn.com or reach out on live chat on LMN, and our representatives there will do our best to give you our recommendations on the best practices for building a field labor budget.